In this lesson, we're going to pick up from where we left off last time, where we had gone in and made the calculation for goodwill for this deal between Apple and Research in Motion. And we saw before that the reason we need goodwill in this context is because if we just go in and try to add up the company's balance sheets as is without making any adjustments, then what happens is that they're wildly out of balance because the shareholders' equity number that's being wiped out on the seller's balance sheet is significantly less than the purchase price that Apple is paying for RIM here. And we saw some of the items that we need to fix this deficit and to plug the hole, so to speak. The main one being goodwill, but we also have new intangible assets being created, a PP&E write-up, and then some deferred tax liabilities being destroyed and then created right here. So with this calculation in place and with our balance sheet adjustments calculated, what we want to do now is go back to our merger model and back specifically to the part where we look at the balance sheet and actually try to combine the balance sheet here. And we want to go down and actually make the necessary adjustments to make sure that we're reflecting goodwill, deferred tax liabilities, and all the asset write-ups and write-downs that we looked at in the previous lesson. So to start from the top here and go down, so for cash and short-term securities, we're not going to change anything here. We already have the only adjustment we need. All we need to do here is reflect whatever Apple is paying in cash for the company. So we have that in place. For accounts receivable, inventory, deferred tax assets, and other current assets, we're going to say 0 for all of these. The reason for that is that in a merger, nothing special is going on with any of these. It's really pretty simple. You just take the company's different assets, you combine them together. Cash is the only one here that's different. Now for the long-term assets, it's a little bit different because we have some adjustments we need to make here. So for long-term securities, this is going to be 0 because we have nothing here. We're not revaluing these in any way. For plants, property, and equipment, remember that we're assuming in our merger model a write-up here. So what we want to do is link in directly to this PP&E write-up amount right here. And now we're reflecting the fact that the value of our PP&E, at least for the seller here, is going up. It's being revalued as part of the acquisition here. Now for goodwill, what we want to do here is we want to take the negative of the existing goodwill of 147 right here, and then add in the new goodwill that's being created down here. Now another way to do this, we could just take the seller's goodwill right here, and we could actually change the formula, so we're just taking the negative of the 147 right here. It doesn't really matter which method we use. I'm just doing it this way to keep all of our calculations in one area and all referring to this area for the goodwill creation and balance sheet adjustments. Now for the intangible assets, for this one, similar to PP&E, we are just going to be assuming a write-up here. So for this one, I'm going to link over to the intangible asset write-up, and we see that we get around 7 billion worth of new intangible assets being created. Other assets, we're not going to change anything here, so this is just 0. So now we see that it's much closer. We have 80 billion, 884 million versus 78 billion. So we're getting much closer now. Now on the liabilities and shareholders equity side, so for current liabilities, we're not going to have any changes here. These are all going to be 0. For long-term liabilities now, so deferred revenue, no changes to this one. Long-term debt, we already are pulling in from the merger model, so we don't need to change anything there. Deferred income tax liability. So remember that what we're doing in our calculation here is we're writing down the existing one, and then we're creating the new one of around 2 billion here. So we're going to take into account the write-down and then the creation of the new deferred tax liability. So we have that, and again, the reason this happens is because when we write up the intangible assets and PP&E, we're writing that up for financial reporting purposes on our books, but for tax reporting purposes, the value is not written up accordingly. So as a result, we get a difference in the tax rates having to do with the depreciation and amortization of those assets over time. And so we reflect that by having a deferred tax liability on the balance sheet right here. Other long-term liabilities, we're going to set this to 0. And then for total liabilities, I'm just going to sum up these numbers. So we have all that in place. Now going down for shareholders' equity, we've actually already made all these adjustments, so we don't need to change anything else here. We see that we're basically just taking the negative of the seller's shareholders' equity numbers because we're assuming that everything gets wiped out and this goes to 0 for the seller. So with that in place, I'm just going to add up all the adjustments here. We see that now actually our balance sheet, the combined balance sheet for both companies balances. We have 80,884,000,000, and then on the asset side, we have 80,884,000,000. Now, if you wanted to, you could go back and play around with some of the numbers here. So as a quick example, let's say I change this to $100 per share, and maybe this is a 50% cash, 50% debt deal with 0% stock. With 0% stock, let's go back and we have 81,821,000,000, and we have the same number for our assets. So you can go in and play around with the numbers if you want to verify that this balance sheet is always going to balance. And that's actually a good idea when you're creating a model like this, to test different numbers, different scenarios to make sure that everything balances correctly. For now, I'm going to change these numbers back to the original ones. And really the only remaining item now with these balance sheet adjustments and goodwill is to go down to our combined income statement and start reflecting some of the changes here. So specifically, we need to show the depreciation of the new PP&E, the amortization of the new intangibles, and we need to be adjusting our operating income here accordingly. So we're going to do that in the next lesson, where we'll complete this process of calculating goodwill, intangible assets, and adjusting the balance sheet properly, and we'll see how we can actually apply these changes, take these numbers that we've already calculated, and apply them to the combined company's income statement.